Hey everyone, welcome back to Corporate Decoder, the place where we break down the secrets hidden in plain sight in corporate America. And today we're diving deep into NextEra Energy's Q2 2025 report, a company that powers more than just homes, it powers our understanding of big business ag. So grab your coffee because we are about to decode the financial story behind NextEra Energy and Florida Power and Light for the second quarter of 2025. And trust me, there are some numbers here that tell a very interesting story about their direction and where they might be heading. Stick around and be sure to join our Discord or corporate filings. Let's jump right into the core financials, starting with NextEra Energy's income. For the 3 months ending June 30th, 2025, the total operating revenues hit a massive $6.7 billion. Compare that to the same period last year, which was $6.069 billion. That's a solid jump, showing they're bringing in more money from their core business of selling energy. Now, looking at the 6-month period for 2025, revenues reached $12.947 billion, up from 11i core business of selling energy. Now, looking at the 6-month period for 2025, revenues reached $12.947 billion, up from 11.8L1 billion in 2024. This upward trend in revenue is definitely a good sign, but revenue is only one piece of the puzzle. What about the bottom line, the net income attributable to NextEra Energy itself? For the second quarter of 2025, it came in at a very strong $2.028 billion, a significant increase from $1.622 billion in the second quarter of 2024. This growth in profit is what investors love to see. However, when we look at the 6-month period, net income attributable to it actually decreased to $2.862 billion in 2025, down from a much higher $3.89 billion strong $2.862 billion in 2025, down from a much higher $3.890 billion in the first half of 2024. This growth in profit is what investors love to see. However, when we look at the 6-month period, net income attributable to NE actually decreased to $2.862 billion in 2025, down from a much higher 3.890, a significant increase from $1.622 billion on the second quarter of 2024. This is a crucial point to watch, a pretty big drop in profit over the first half of the year. Let's break down why. The report highlights that the NER segment, which includes their renewable energy generation, saw a significant drop in profit for the first half of the year. They mention an impairment charge related to an investment in XPLR and higher interest expenses. Specifically for the 24, this is a key area that pulled down the overall results. Digging into that XPLR issue, the report mentions a significant impairment charge. This means they had to write down the value of that investment because it lost value. It's like admitting that a particular part of their business didn't perform as expected, and they had to recognize that loss on paper. This particular write-down cost them a hefty $604 as expected, and they had to recognize that loss on paper. This particular write-down cost them a hefty $604 as expected, and they had to recognize that loss on paper. This particular write-down cost them a hefty $643 million after tax in the first half of 2025. Then there's the corporate and other category. This part of the business actually got worse in the first half of 2025. Profits here dropped from a positive $68 million in the first half of 2024 to a negative $84 million in the first half of 2025. The report blames higher average interest rates and debt balances for this. It seems the cost of borrowing money is really starting to bite into the company's overhead. Moving over to the balance sheet, which is a snapshot of what a company owns and owes at a specific point in time. On the asset side, total assets for NextEra Energy grew to $98.3 billion by June 30, 2025, up from $99.40 2025. Up from 99.4. This growth is mainly in their property, plant, and equipment, which makes total sense given their business. On the other side, total liabilities, redeemable non-controlling interests, and equity also increased to $19.830 billion. Their long-term debt is a significant part of this picture, standing at a massive 82.69 needs to be watched closely. Now let's look at how the different parts of the business are doing. For the full 6 months of 2025, FPL, their utility business, brought in $2,001 billion in net income. That's up from $204 billion in 2024, so FPL is performing well and growing. However, NER, their competitive energy business, saw its net income attributable to NE drop considerably from $6.946 billion in all of 2024 to $1.50 FUR. There is APLR investment issues and rising interest costs we talked about earlier. FPL's operating revenues for the second quarter of 2025 rose by $319 million compared to the previous year. This increase was largely due to storm cost recovery revenues, almost $308 million more related to hurricanes from last year. So they are recovering costs associated with repairing storm damage. On top of that, their retail-based revenues also went up, driven by a growth in customer accounts. A big chunk of the increase in FPL's expenses was in depreciation and amortization. This went up by $386 million in the second quarter and $491 million in the first half of 2025. A big part of this increase is linked to those storm cost recoveries we just mentioned, where they are amortizing or spreading out the cost of storm damage over time. Now, back to NER. Their performance was impacted by a lot of moving parts. When they talk about new investments, they mean earnings from newly operational wind and solar projects. These new projects are doing well, adding $298 million to their profit in the second quarter of 2025 compared to the prior year. Similarly, for the first half of the year, these new investments brought in an extra $36 million. This shows their strategy of investing in new renewable energy projects is paying off, at least for the new ones. However, things like change in non-qualifying hedge activity and changes in unrealized gains and losses are making the results volatile. For NER, the change in non-qualifying hedge activity actually helped their profit 2025. A nice swing from a loss in the prior year, but for the first half of the year, this area was a drag with a decrease of $59 million, showing how unpredictable these financial instruments can be at the company level. Scrolling's total mark-to-market energy contract net assets, liabilities at June 30, 2026. Liability at their financial position, NextEra Energy has a significant amount tied up in mark-to-market energy contracts. By June 30, 2025, they had net liabilities of $380 million. It shows the complex financial world they operate in to manage energy prices. The sources of these fair value estimates are varied. When they talk about quoted prices in active markets for identical assets, that's the most reliable way to value something like a stock traded every day. But when they have to use significant unobservable inputs, that's where things get a bit more subjective based on their own models and estimations. Now, let's talk about interest rate risk. You see, when interest rates change, the value of their debt and some investments can also change. NextEra Energy estimates that if interest rates were to drop by 10%, the value of their net liabilities would increase by a whopping $37 billion. Ouch. This highlights how sensitive their business is to even small shifts in interest rates, especially with that massive debt load. They also face credit risk, which is the chance that someone they do business with won't pay them back. They say their credit risk exposure is around $2.9 billion, but most of it, over 90%, is with companies that have pretty good credit ratings. So they seem to be managing this risk, but it's always a factor when you're dealing with counterparties in the energy markets. Finally, let's look at the exhibits. This is where companies file important supporting documents. We see things like officers' certificates for new debt issuances and employment agreements, like the one for their Chief Financial Officer, Michael Dunn, which is good to know who's running the show. So looking at the big picture for NextEra Energy, my take is that they are a fundamentally strong company with a clear strategy of investing in renewables, which is a growth area. FPL, their regulated utility, is performing steadily. However, the NER segment shows some significant challenges. The drop in profit in the first half of the year, largely due to that XPLR investment issue and the rising cost of borrowing, is a concern. While they are growing their renewable portfolio, the volatility in their financial hedging and the increasing interest expenses are risks that investors need to keep an eye on. They are navigating a complex financial landscape, and while they have managed risks in the past, the current environment with higher interest rates and the specific issues with XPLR warrant caution. What's your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching. See you next time.